On Wall Street, stocks dropped as bond yields moved lower and inverted, a technical phenomenon we've been telling you about that has preceded recessions in the past. That sent bank shares lower, and if you add in some concerns over trade, you have a down day for stocks. The Dow Jones Industrial Average fell 120 points to 25,777. The Nasdaq was down 26, and the S&P 500 slid 9. So let's turn now to Mike Ryan to talk more about the stock and the bond market. He is the Chief Investment Officer at UBS Global Wealth Management Americas. Mike, welcome. Nice to have you here.
Thanks, Sue.
You do not see a recession coming. You think the U.S. can avoid a recession, but you are paring back some of your equity positions.
We are, again, we don't see a recession, at least not over the course of the next 6 to 12 months, even though we are seeing some signs of weakening in the manufacturing side, and certainly the global economy has decelerated. Yet what you have balancing off is very strong labor market conditions in the U.S. and a pretty healthy consumer sector as well. So the risks of recession are still fairly low in our estimate. That doesn't mean, however, that we won't want to pare our risks back a bit because some of the uncertainties around trade. What we've just recently done is taken some of our risk exposure off with regard to equity markets and just gotten me a little bit more defensive in terms of our portfolio positioning.
Mike, I want to ask you about something that happened today. It's only the second time it's happened in the last 40-plus years, and that is the yield on the 30-year Treasury bond dipped below the yield of the S&P 500 index. Now, what we're looking here is a chart that takes us back to the late 70s, and you see that the spread between the two has been narrowing for years, and now the 30-year yields less than the stock market. What does that mean to you and the outlook for stocks?
Well, Bill, I think we have to be really careful here because I'm not sure that tells you a lot. It's more coincident than it is really a sense of cause and effect. Because remember, there were certainly periods in the past where we've had both recessions and bear markets where the 30-year bond was materially higher than what we had the S&P yield. So the notion that it's somehow, because it's dropped below some technical level, that it's suggestive of recession or a bear market, we have to be careful not to overinterpret that.
Well, I would point out that the last time it happened, the only other time it happened was in March of '09, and that was a major bottom for the stock market.
Yeah, that's true. But remember, there were other bottoms in the stock market when you had the yield on the 30-year was materially higher. So the notion that simply the spread between the 30-year bond and the yield that exists on the dividends for the S&P 500, that it's somehow a forecast vehicle or it's somehow going to indicate either recession or bear market, we have to be careful not to overinterpret that. What I will say, though, is as yields fall, what it is a sign of is that there's concerns about global growth and also there's concerns about the Fed's ability to generate a level of inflation that's more in line with their target of 2%.
That was going to be my question, but you answered it for me. Thanks, Mike. Appreciate it. Mike Ryan with UBS Global Wealth Management Americas.